A third way that people can leave money to a charity, of course, is by naming the charity itself as the beneficiary. So I own a policy on myself right now, let's say for $500,000. So in this case here, Rohan owns $500,000 policy on himself. He pays his $12,000 premium and so on and so forth, okay? And the charity is the beneficiary. Now, in that case, then there's no immediate tax receipt whatsoever, because you see, the money hasn't arrived from the charity yet, even though I am paying the premium. And yes, the beneficiary is there's the charity. And so yes, upon my death, the charity will receive the funds and everything else. Point is, there's no immediate tax relief for right now. So if I'm not interested in tax relief now, okay, then I can simply buy a policy on myself, pay my premium, and leave the beneficiary to the charity. So there's no immediate tax relief for me right now. Okay. However, upon my death, the tax receipt will be issued to the estate. So in this case here, Rohan owns a $500,000 policy. He has a $12,000 premium. No tax implications at this point. No tax relief of any kind. Okay. When he dies, the $500,000 gets paid to the charity. The charity then will issue a tax receipt for the entire $500,000 to the estate of Rohan. So then what can happen, of course, is that $500,000 can be used for credit towards the current year. In other words, to offset current year's maybe taxation issues that they may have. So, for example, the estate owes considerable sums of money. By having this rather large tax receipt, it could certainly mitigate a great deal of tax situations. And the charity's happy, of course, because they've got $500,000. The estate then can use that $500,000 tax receipt to solve the issue on a current basis, based on offset any kind of taxable income at the time of death. Or they can actually go also the past 2 years. So if they can't use the entire $500,000 for this particular year, let's say the current year, they can certainly go back and reassess for the last 2 years and use it for that. And therefore, quite possible that the estate could receive a refund for the last 2 years' taxes that they might have paid. The estate could be beneficiary of a considerable amount of refunds and everything. But again, I would stress to you that in this case here, the client is saying, I'm not interested in having any tax receipt right now. In other words, tax rate right now while I'm alive. Okay, I really would rather have my estate solve the problem for my estate. So that's really my concern, is that I want to make sure that my estate has enough receipts and everything else to offset any kind of tax liability they have. So if all they're concerned about is really a state issue, then having a policy and having the charity actually own it, the charity being the actual beneficiary, then it's not a problem. So, but you don't get any tax receipt right away. It'll all be at the other end. Whereas the first two options, of course, gave you immediate tax relief now, but did not give the estate tax relief. In other words, it basically is, if you want tax relief now, you can set it up like that, whereby I'm paying the premium, and the charity owns the policy, and so on and so forth. Okay, I get tax receipt right now. Okay, but if I own the policy and I'll continue on paying the premium, and then all I really want is for my estate to actually get some kind of tax relief and everything else, then this particular situation is your best option and everything. Okay, and so therefore that $500,000 will go to that charity. They'll get issue a tax receipt to the estate, and the executors of the estate then can use it for the current year situation or go back 2 years. So basically, you can use it for the last 3 years, you might say.